Every year delivers a surprise breakout, and 2025 was no exception.
1 minute and industry is left for dead, and the next it's ripping higher.
Just look at what happened this year. Gold, defence, critical minerals, uranium, all delivered really strong returns.
And surprisingly, even the hydrogen sector exploded onto the global leaderboard as one of the year's top performers.
Meanwhile, sectors like ASX technology and healthcare really struggled.
So we're asking the fundies which industry is poised for a breakout year in 2026 and which stock best represents that trend.
These calls are all in good fun. Do your own homework and remember that any investment thesis can shift as the year progresses.
What sector you think is going to have a breakout year and the one stock to ride it?
Well, going back to my materials and resources theme, I think the copper industry is set for a strong year, a breakout year if you like. Since 2021, there have been 57 different M&A activity or M&A cases. That's an extraordinary amount of consolidation. In today's paper, you can see this is the Australian Financial Review. We're now on mainstream paper, mainstream news, that the supply side of copper is contracting. Essentially, there's consolidation occurring. Just as demand starts to tighten, demand is strong for copper, supply is contracting, and we're creating, therefore, a deficit situation, so a deficit of supply situation. Demand is strong for, obviously, with the whole energy transition process and DC data centre construction process. There's hoarding of copper going on. Meanwhile, the supply side tightens. So Citigroup are forecasting a 300,000 tonne deficit starting this year. So I think copper is set to continue its rise. And I guess the stock that we would suggest is a great exposure is a stock that recently struck an all-time high, and that's Sandfire Resources, which is an international copper play. But importantly, it's growing its copper production. It'll be at 150,000 tonnes of copper production in short order. And we're excited about copper, and we're excited about the prospects for Sandfire.
Well, we've picked an industry that's been facing a trifecta of headwinds for the last couple of years, being the building industry, particularly companies exposed to the US building industry. So within this year, you've had a very, very difficult broader housing market. And the main reason for that is almost everyone with a home loan fixed their rate during the COVID years. And so a lot of those loans are fixed in the 3 to 4% range. Current mortgage rates are between 6 and 6.5%. And so very few people want to extinguish their old mortgage and acquire a new one because of the cost of doing so. And that's leading to very, very low housing turnover in the US, which is obviously leading to a subdued environment for companies that are facing the housing market. In addition to that, you've had the imposition of tariffs, which has negatively impacted cost of goods sold for a lot of those businesses. And there's been pretty stiff competition amongst the domestic market. So we think as the companies start to cycle that in 2026, it'll really come back to what the companies are doing themselves to improve earnings over time. The company that we really like in this space is Reece. So they've faced the trifecta of issues in 2025. We think we're probably seeing the earnings trough at the moment. The market will start to look ahead of that. And people have forgotten that the organic opportunity in the US in what is an enormously fragmented domestic market is simply enormous. And we think that the company initiating first an off-market buyback at a significant premium to the share price, and now an on-market buyback that's due to commence shortly, is a pretty good indicator that they see a lot of value on a through-the-cycle basis. So we're pretty excited to see the operating leverage that we expect to come through in 2026 and beyond, and we think the market will probably start to price that a little ahead of time.
I do think technology is still the number one place where you want to be. One stock in Australia is Life360 that we own, and in global we own Applovin, which is an ad tech business. The two of them are exposed to very similar themes in technology. It's about productivity, it's about efficiency, it's personal and it's corporate. So like there's a whole range of sort of themes that are very common across those two ideas. But I do think technology as a group is probably the number one theme that will continue throughout 2026.
Well, I'm going to push our own barrow, but I think Pathology is showing some signs of a turnaround. And Pathology has been in the doldrums since COVID. Obviously, there was a lot of the PCR testing at the time, and that drove strong volume growth for the pathology operators. Since that time, you've seen funding cuts from the government, and that's the one problem with the industry, is the government is the biggest customer. They're the majority of revenue. and they've cut revenue. And they did budget for more cuts this year. So they've cut the B12 test and the urine test, which has been another headwind for the pathology industry. But what we saw in the first quarter of the year is actually positive trends from two of the companies, and that ACL came out and said that their first quarter is flat in terms of revenue, despite that 3% headwind from those testing cuts. And Healius, which we own, came out and said they had 3.9% growth in the quarter. So some signs that they're actually overcoming those challenges in terms of pathology growth and funding cuts. And we think that augurs well for the industry. So we're invested in Healius. We think there's a good turnaround story there. The management seems to be making some inroads. That top line growth is an indicator that they're getting on top of some of the challenges. But it's not without risk. I think the first half result is going to be pretty weak. But we can see, long term, that the company can produce better earnings than they're currently making now.
Resources. For us, it's an area we've always been able to play in, but we think the environment's looking fantastic. So we can look at gold and silver this year, and everyone's seen the fantastic performance of that area. We think it starts to broaden out. You know, the world is becoming more commodity intense. There just hasn't been that investment. The good deposits are getting deeper, harder. All of those kind of things mean that we think that there's a step out in resources over the next couple of years. Both supply and demand side look fantastic, and if we can find some commodities where that price signal is sending us the right message, it's a good ore body, they can dig it out of the ground at the right price, that's a fantastic outcome. So, you know, we really like tin through Middles X, we like the base metals through Aurelia and Poly. There's a whole group of stocks there to play, but we think that base metals commodity sector is going to be a really, really good performer this year.
I'm going to pick healthcare here. Healthcare actually had a pretty tough 2025. There are a lot of regulatory concerns in the US with, differing rules from the Trump administration and how they're going to pay for drugs and so on. But those have started to ease off towards the end of the year. We're getting more certainty there. And we know it has some nice underlying demographic drivers, the aging of the population. So it's really poised for a much better year in 2026. Medtronic is a good example of that. They're a really solid, high-quality company. They've got a couple of new products that could drive revenue growth as well. United Health had a particularly tough year in 2025, but they're poised to recover in 2026 as well. So a couple of good options there.
I'm a broken record on this, so that's a big caveat up front. But I think 2026 will be the year that inbound tourism into Australia really gets back to where it was pre-COVID. It has been painfully slow to recover from pre-COVID. This year, 2025, we will still only have 90% of the inbound tourists arrive that we had in 2019. And I would have expected that to be above 2019 levels by now. But we are seeing the trends head in the right direction. We've got the Barmy Army out here for the cricket this year, sending photos home. We had a hugely successful Sydney Marathon last year, photos beamed all around the world. You can see the numbers marching up every month. So one stock in our portfolio that's exposed to that is Tourism Holdings. It's been a painful couple of years for this stock and business, and I think 2026 will be one where it gets a little bit friendlier for them.
We believe the stars are aligned for resources. When we combine the positive outlook for cyclical and value and the outlook for global growth, they really are in the sweet spot. Now, it's not necessarily a breakout. I'd say materials was the best performing sector in 2025 with returns of, I think, around 20%. But we believe it has further to run. Our preferred exposure is Rio Tinto, the ticker is RIO. And that is because if you look at where the spot prices are, there is around 30% upside to their earnings. They have a cost out program underway to the tune of a couple of $1 billion. They have $5 to $10 billion of asset sales underway that will release cash. And overall, we're just really pleased with the strategic direction that the company is taking. So when we combine the earnings upside with the valuation, we think there's further valuation in it too. We see Rio as our preferred play.
I think the top industry to experience a breakout next year is actually European banks. So European banks have experienced a bit of a winter over the last sort of decade, or 2010 to 2021. After the GFC, they were doing things like shoring up their balance sheets, making sure Tier 1 capital was nice and strong. And they kind of, I guess, didn't really grow during that time. Now they're actually kind of emerging from that winter and experiencing this period of growth. We think the best stock to ride that wave is UniCredit. So UniCredit has an exceptional cost to income ratio of 38%. It's got strong growth coming through. You've seen their CEO talk about, I guess, the credit boom coming again in Europe. And I think that you'll see that play out in 2026.